Hi, I'm Ed Alexander, attorney and founder with Alexander Abramson, a business law firm. And I'm here today with my good friend George Rosen. George and I have known each other for about 15 years now. And George is a business broker and a business appraiser. And he and I wrote the book, Your Definitive Guide to Buying a Florida Restaurant. And George has put together some pretty interesting information that I thought really would make sense for us to kind of talk a little bit about. And that is the effects of financial source data on the purchase price. Now, George, that's a mouthful. So what's the nomenclature we would use as everyday business people with regard to this?
Quite simply, every buyer wants to know, what did the business gross, top line revenue, and what did it net in the form of adjusted owner benefits or discretionary earnings?
Right, so the owner benefits being?
What's in it for me if I buy this business and I don't take a salary? How much is left on the bottom line?
Right, and so that differs from net income because?
Everyone wants to minimize the tax bite, so we're going to expense items and deduct items for tax reporting that are perks of owning a business, such as my automobile, such as club memberships, things that we have to add back in to really identify what is that true benefit of owning that company.
Excellent. So you put this information together from a database, right?
The Business Brokers of Florida sold database.
Excellent. And so tell us what we're looking at here.
Okay, now there's a lot of information on this table, but we're only going to focus on a few of the key lines. But we've got 530 sold companies. And these are all restaurants, but we've got it broken out by what was the source data, whether it came from a tax return, whether it came from a profit and loss statement, whether we took a part year and then, if we were in June, doubled it to say this was an annualized full 12 months or an owner approved. So when we start looking at these different businesses and what they sold for as a multiple of revenue or a multiple of adjusted net or discretionary earnings, we find out that the more reliable the source data, the higher the sale price.
So let's go take a look at the financial source. Let's just talk a little bit about what those four are, okay? So I'm going to go backwards on your list here. So owner approved, what does that mean?
Means that you're not going to see the same information that I'm telling you on my tax returns, but you need to take my word for it.
And then annualize?
That's taking part of a year and then doing divides it by how many months are included in that part year financial and then multiplying it by 12 to come up with a full 12 months. If we're doing $600,000 in the first 6 months, we're going to do $1.2 million this year.
The assumption is that we'll do $1.2 million. Okay.
Assuming no seasonality.
Okay. And then P&L statements, those are what your bookkeeper or your accountant put together. And then tax returns?
Obviously what got reported to the IRS.
What we filed with the IRS and had to sign our name to under penalty of loss. So let's go into the details here.
Okay. The least reliable source of information is going to be the owner approved.
That's shocking.
And if we take all of those businesses and we say, well, what did they sell for as a multiple of revenue? We find out that they only sold for 35% of their sales. That's the same as 1.76 times, or just say almost 2 times what they're going to make in a year.
Okay.
Now, if we go and look at the most reliable source data and we look at the tax returns, we see those sold for 42% of sales compared to 35% of sales. That's 17% difference on the gross revenue multiplier as a way to say, if I grossed $1 million, I'm going to sell for $420,000. But if I'm only using an owner to prove, and I tell you I grossed $1 million, I'm not going to sell for $420,000. I'm going to sell for $350,000.
Pretty steep decrease.
It's even more of a great disparity when we start talking about multiple of owner benefits. If we use those same 2 sources, owner to prove sold for 1.76 times the adjusted net. The tax returns, on the other hand, sold for almost 3 times. And that's a 40% difference. So as a seller, if you want to get the top dollar, report all your sales, include that, and file and pay your taxes, and you're going to get a lot more money when you sell your business.
So if I'm a seller doing that, if I'm a seller that maybe isn't reporting everything on my taxes, and I have this idea that I want to sell in the future, what do I need to do?
Clean up your books and records, start paying the fair share of taxes, report everything so you can prove it, support it, And with at least 2 years of historic data, you'll be in that camp that's going to sell for the premium 3 times what you're going to make in a year.
Excellent. Great. Well, thank you very much. Okay, we've talked about the impact on the seller. Let's talk about the impact on the buyer.
From a buyer's perspective, the reason why we want to know what the historic earnings were is because we want confidence in what we expect to happen once we buy it. And if we're going off of seller-approved financial information as opposed to what's already been verified as reported to the IRS, our confidence isn't there. When the confidence is lower, we're not going to go as far out on that limb and pay more money for a business with more risk.
Gotcha. Now, in terms of somebody who's an experienced restaurateur, how does that impact it?
Most experienced business buyers already have a high confidence level with what they're going to do when they buy the business, so the financial reporting is not as critical. But if somebody is coming into a new industry without a lot of industry experience, they need a good running head start.
And then in terms of the buyer then coming in, are they going to, experienced buyer, so experienced restaurateur, what's the impact on price on that?
Experienced buyers typically don't pay as much money for the same business.
Now, what's the impact on financing?
If you've got good source data, tax returns specifically, you can get financing. If it's owner approved, you're not going to get financing.
It's done unapproved. Excellent.
And with financing, you can afford to pay more for a business because you're coming in with less money down and your payments are structured so it's less per year you're paying to buy that business rather than all up front.
Thanks, George. If you like these videos, please subscribe below. We have a bunch of great information for business buyers and business sellers. Thank you.